Many of you saw the breakdown between global liquidity and Bitcoin, which happened in the last 18 months. It doesn't mean that the everything code is wrong. It's liquidity shifts around in its influence and where it's driven. And a lot of it went into the AI trade. And Bitcoin basically got down to the narrowest measure of liquidity, the pure debasement side that drives it, which is telling us there's less speculation in crypto than there is in AI, less capital is being attracted, but it still is driven by the debasement cycle.
Over the last 18 months, one of the most heavily criticized ideas in crypto has been Raoul Pal's Everything Code, the framework that argues global liquidity, debt refinancing cycles, and monetary debasement ultimately drive nearly every major asset class, including Bitcoin. As Bitcoin failed to follow some of the traditional liquidity models, and the much-discussed banana zone never fully arrived, critics were quick to declare the theory dead. But according to Pal, that's not what happened at all. In fact, he argues that the apparent breakdown between Bitcoin and global liquidity wasn't evidence that the model failed. Instead, liquidity itself changed direction. Rather than flowing into crypto markets, a significant portion of global capital was diverted into one of the biggest investment themes in modern history, artificial intelligence. The money printer never stopped. The destination of that money simply changed. And now, as the Federal Reserve prepares for another closely watched policy meeting, Powell believes we're approaching a critical turning point. Liquidity indicators are beginning to improve, financial conditions are shifting, and several of the macro signals inside his Everything Code framework are flashing the same message. If he's right, the disconnect that frustrated Bitcoin investors over the last year may soon reverse, potentially setting the stage for the next phase of the cycle. So in today's video, we'll break down why Powell believes Bitcoin is currently undervalued relative to liquidity, why excess liquidity could become one of the most important drivers of markets heading into the midterm election cycle, how the Fed and Treasury fit into the equation, and why he thinks the business cycle still has plenty of room left to run. If you enjoy macro analysis that helps make sense of Bitcoin's biggest moves, be sure to like the video, subscribe to the channel, turn on post notifications, and let me know in the comments whether you think the Everything Code is still intact or if the critics have a point.
If Warsh and Besant want to goose markets' returns and people's pockets into the midterm elections, they're going to have to drive up these measures of liquidity. Because if not, we keep getting the Y-shaped economy because most of this liquidity doesn't flow into regular lending or regular activity. The rates are too damn high for mortgages for people to afford, and the prices are too damn high too. This stuff needs to get fixed, and Scott Bessent is working hard on doing it, because without it, this whole game doesn't work. The other measure that I like to use as part of the Everything Code is excess liquidity. This is liquidity growth in excess of GDP. And if you think about it, it's liquidity that spills into the system for speculation and investment. What we find is, again, correlated with Bitcoin. We've got excess liquidity turning up, and Bitcoin should be following it too. Again, nothing's supposed to be perfect, but contextually, I'm laying out a picture for you where Bitcoin and crypto is undervalued versus most of the liquidity measures, but its influence by them is very clear. So when we look at excess liquidity, both at the broad measure and the narrow measure, they're both just about positive. And they haven't really been positive for a while now. And we need this to be more positive over time. When we go back to see all-time history, we've tended to have extended periods where it's much higher. And we need that. We need excess liquidity to drive other assets to flow into the generalized economy. If not, we keep creating the K-shaped economy. And then we're on top of the K-shaped economy, we're debasing the currency. So those wage earners, the average person, gets because they don't own enough assets. And assets are the only thing that go up. So the rich get richer and the poor get poorer. And this game, is highly political now. You can see it spilling into the UK, all across Europe, into the US. This is politics right now. It's all based on these problems. Debasing the currency drives up asset prices. The average person doesn't get a look in. House prices are too high. Mortgage rates are too high. So they're just left on the sidelines. and it's not fair. How do you answer it? Well, we've got to grow our way out of it. We've also got to allow some leverage back into the system, some lending back to people so people can buy houses, etc. Try and get the rates down, hoping that the productivity boom from AI starts lowering inflation over time and allowing rates to come lower. Excess liquidity means that there's enough money for us to start speculating in because we've got some excess money around. And that means that we can start driving returns. So it's really important to get this done. So those are other component parts that I think are important. We also need productivity to rise. Productivity is part of the magic formula. And productivity minus inflation is still negative, but once it goes positive, then productivity is outpacing inflation. I think that is going to happen this year, and then it'll trend higher over the course of the next 4 or 5 years plus. And in which case, that's the right market for bond yields to fall, for GDP to grow, for the wealth effect to spread out, and eventually less debasement of currency that's screwing everybody. Financial repression, well, this is 5-year Treasury yields, which is roughly where the refinancing is, minus nominal GDP growth. And what we've got is interest rates are still below nominal GDP growth. That's stimulative. It's financial repression. They should be higher, but they're kept lower. Let's now flip across to the business cycle. So the business cycle is now really driven predominantly by the debt refi cycle, but it drives everything. It drives all asset prices. It is where our corporate earnings come from, where our increase in wages comes from. It's where unemployment comes from. It's where inflation comes from. They're all component parts of the business cycle. And within the everything code, we have the everything code dominoes. The dominoes are allowing us to look into the future and understand what is coming.
What makes Pal's argument particularly important is that he isn't simply looking at headline money printing. He's focused on excess liquidity, the amount of liquidity growth that exceeds economic growth. Historically, that's the capital that eventually finds its way into investments, speculation, and risk assets. In his view, Bitcoin's current valuation doesn't fully reflect where these liquidity measures are heading, especially if policymakers continue pushing for stronger growth and easier financial conditions ahead of the next political cycle. But the real foundation of the everything code isn't Bitcoin itself. It's the sequence of macro dominoes that Pal believes drives virtually everything in financial markets. To understand why he's still bullish despite the turbulence of the past 18 months, we need to look at the chain reaction that starts with financial conditions, flows into liquidity, and eventually impacts everything from Bitcoin and stocks to GDP growth and inflation.
So at the front of all of this are financial conditions, and we'll look at those in a minute. Financial conditions in our context, a global macro investor, are really about the dollar and interest rates and a deviation from trend. We calculate an index from that, and that tends to lead the ISM, the business cycle, by about 9 months. So we sort of know what is coming. But it also, and gold seems to currently live, and gold shifts around, but gold seems to reflect current financial conditions. So as a proxy, you can use the gold price to say, what is the business cycle going to be doing in 9 months' time? Again, we're not looking for perfection, but we're looking for contextualized understanding and an ability to see into the future somewhat. To see, you might not part all of the clouds and all of the fog, but you can see generally through to the other side. The next thing is it leads liquidity by 3 months. And liquidity is the thing that we track the most because it's the single most dominant factor in all of macro history right now. It's the printing of money. So that's 3 months behind financial conditions. And then behind that, we've got Bitcoin, NASDAQ, the yield curve. So now we're now into asset classes, and we can see now that liquidity leads Bitcoin, financial conditions leads liquidity, which leads Bitcoin. So it's giving us an ability to forecast somewhat, not to perfection. Many of you saw the breakdown between global liquidity and Bitcoin, which happened in the last 18 months. It doesn't mean that the everything code is wrong. It's liquidity shifts around in its influence and where it's driven. And a lot of it went into the AI trade. And Bitcoin basically got down to the narrowest measure of liquidity, the pure debasement side that drives it, which is telling us there's less speculation in crypto than there is in AI, less capital is being attracted, but it still is driven by the debasement cycle. Then T+0 today, that's the business cycle. That's earnings. That's where the S&P 500 lives, cyclical equities, small caps, emerging markets, commodities. All of it lives there. Even altcoins in the crypto complex, they're actually driven by the business cycle. And it makes sense because the business cycle is our earnings and corporate earnings, and excess earnings, because the business cycle is strong, go into speculative assets and investments. And so altcoins tend to work there, much like small cap equities do. And then lagging all of that by another 2 to 3 months is GDP and inflation. Now, there's a whole set of inflation dominoes as well around this, but this is what you need to know for the everything code. It's a very useful chart. And we've got here is, for example, we talked about the 3-month lead, the 6-month lead of liquidity to ISM, and here it is on a chart. And you can see it works very well. So we expect ISM to continue to rise. There's this period where it comes off a bit. Now, that's not always matched by these. Is it going to be matched by this time? Will ISM slow down? I don't think it matters because we're not near the top of the cycle. The top of the cycle comes later, and that's where financial conditions comes into play. So here's financial conditions against the ISM. So remember, this is 9 months into the future. We should be seeing ISM weakness. In fact, it kind of suggests that around the end of the year, so let's call it November, we should start to see a shorter term peak in the ISM. And therefore liquidity will have peaked before it, and markets will be choppy or corrective over that period. But other than that, it looks relatively plain sailing. Obviously, we would like to see liquidity pick up, particularly in the US measures, where it's been a bit sluggish. But all the component parts are in play. We're in full cycle expansion. Everything's moving forwards. We've got a warning sign in the future. That tightening of financial conditions was driven by Iran and the strength that caused in the dollar and interest rates. Now, if that begins to unwind, which I think it will, then we'll extend the business cycle out further after having some corrections in markets. It kind of makes sense. We go into the midterm elections, we correct afterwards. You know, we saw that we kind of were really strong after the US election, and then beginning of the year, everything went south. And I think, you know, that's not unreasonable to ask. And that will probably happen with technology stocks as well as crypto. The markets in general, they'll need to take a pause. But, you know, they're going to try and goose the economy and the markets as hot as possible going into the midterms.
If there's one message that ties this entire presentation together, it's that markets don't move randomly. According to Pal, there is a sequence. Financial conditions influence liquidity. Liquidity influences asset prices. Asset prices influence economic activity, and eventually those effects show up in GDP, inflation, and the broader economy. The challenge for investors is that these relationships operate with long and sometimes frustrating delays, making it easy to mistake a temporary divergence for a complete breakdown. That is exactly what Pal believes happened with Bitcoin. While many investors interpreted the past 18 months as evidence that the liquidity thesis had failed, he argues that liquidity never disappeared. Instead, capital was pulled toward AI infrastructure, technology spending, and other emerging opportunities. Bitcoin continued tracking what he calls the narrowest measure of liquidity, the debasement cycle itself, even while broader liquidity relationships became distorted. Looking ahead, Pal sees several factors potentially lining up in favor of risk assets. Financial conditions remain broadly supportive, excess liquidity has started turning positive, productivity gains from AI could help reduce inflation pressures over time, and policymakers have strong incentives to maintain economic momentum heading into future elections, while he expects periods of volatility and even corrective phases along the way. His broader view remains that the cycle has further to run. Whether you agree with Raoul Pal's everything code or not, one thing is becoming increasingly difficult to ignore. Liquidity continues to sit at the center of almost every major market conversation. And if his framework is correct, the next moves in Bitcoin, crypto, stocks, and even the broader economy may already be taking shape beneath the surface long before most investors notice. If you enjoyed this video, make sure to hit the like button, subscribe to the channel, and turn on post notifications so you never miss an update. Also share this video with anyone trying to understand where Bitcoin and the macro cycle may be heading next. Thanks for watching, and I'll see you in the next one.